And let's start with our tier list. And the first valuation ratio is the price to sales. For this ratio, you divide the stock price by the revenue of the company. So it's a valuation about the revenue. And I will put it directly in the C tier. What I don't like about this ratio is that it doesn't take into account the profitability of the company. Two companies can have the same revenue, but one has twice the margins, is twice as profitable as the first one. If they have the same revenue, they will have the same ratio. So profitability has an importance. If I want to invest in the best companies, I want to see if they are really profitable. And because it doesn't take into account the profitability, I will put it in the C tier. The next ratio we have is EV/EBITDA. I will be very quick for this because Charlie Munger said that EBITDA means bullshit earnings. I will put it in the D category because with EBITDA, you adjust the earnings. You don't take into account the depreciation, amortization, or the external costs. Well, you adjust too much the earnings. So for the valuation part, I don't want to use EBITDA. The problem with EBITDA is that because it's adjusted, it could be overly optimistic. And for the EV, if you don't know what that means, that's enterprise value. So that's the size of the company, and you take into account the debt level. So you can say that's quite good, but the EBITDA part of the ratio puts this ratio in the D category. Next one is the PE ratio, one of the most used ratio, one that everybody knows, that's price divided by earnings. So this time you take into account the profitability, and I will put it in the A tier, A category, because you can compare two companies, compare their revenue and their earnings, their profitability, and you can have a good sense of if a company is undervalued or overvalued based on the PE ratio. Our next ratio is just the opposite of the PE ratio. It's called the earnings yield. Just before we saw the PE ratio, the formula is stock price divided by EPS, earnings per share. And for earnings yield, that's the opposite. That's earnings per share divided by stock price. So that's the same formula, just inverted. So I will put it in the A category as well. The next ratio is the price to book. It's often used for asset heavy industries. So you take the size of the company and you divide it by its book value. I don't often use this ratio, and I would say it's becoming less and less relevant because of all the intangibles that you can see in the businesses right now. We have more intangibles. Intangibles could be patents, trademarks, goodwill, all these intangibles from businesses. Well, it doesn't match well with the price to book. And also, I would not recommend using the price to book ratio with the rapidly evolving industries that we have today. So I would put the price to book in the C category. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. The next one is the price to free cash flow. So you take the stock price and you divide it by the free cash flow per share. And similarly to the PE ratio, I will put it in the A category. That's one of the best ratios you could have to see if a stock is undervalued or not, because you compare the stock price with the free cash flow it generates. And free cash flow is maybe the most important metric when you look at the fundamental value of a business. So if free cash flow is the most important part of a business, price to free cash flow is maybe the most important metric. So definitely in the A category. And again, the free cash flow yield is similar to the price to free cash flow. Same thing that we've seen with the earnings yield. It's just the formula, but inversed. So it's the free cash flow divided by the size of the company. So I will put it again in the A category. The next one is the dividend yield that I never use, so definitely in the D category. The goal of this is to use dividends to determine the intrinsic value of a company, and I think that's not correlated at all, so I never use this dividend yield metric, and I will never use it. The next ratio is the PEG, so you take the PE ratio and you take into account the growth rates of earnings, future earnings. I will not put it in the A category because that's too many assumptions for me, and I prefer to use a simple PE ratio to see if a stock is undervalued or not. I don't want to use too many metrics for my valuation method, so that's why it's in the B tier. And the next valuation is price to earnings growth dividend yield. Well, that's almost the same thing as the PEG, the PEG ratio that we've seen before, but you take into account the dividends. And because I don't want to use dividends when I value a stock, it's definitely a D for me. The next one is EV divided by EBIT. So we've seen before EV, enterprise value, that's the size of the company, but you take into account the debt, the cash and the debt level. So you have a better sense of the capital structure of the company. That's for the EV, the enterprise value. And you divide it by EBIT. EBIT is operating income. That's the earnings from the core operations of a company. It's a pretty good valuation metric that deserves to be in the A category. And the last valuation ratio is the EV divided by free cash flow. We've seen before that taking into account the debt level of a company is great. So I would rather use the enterprise value, the EV, compared to the simple stock price. And we've also seen that the free cash flow is maybe the most important metric of a company. So it's like the price to free cash flow that was in the A category, but even better because you take into account the debt level of a company, the cash level of a company. So that deserves to be in our S tier. That's the best valuation ratio you could use to see if a stock is undervalued or overvalued. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a video, a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.